Gold surges to a new record high, over $3,800 an ounce, and US bond yields fall as fears of a US government shutdown escalate. In Australia, the Reserve Bank is expected to hold the cash rate today, possibly with a hawkish tone. That's coming up in our 5 Things in 5 Minutes on Tuesday, September the 30th. And then in our deep dive interview, ANZ Chief Economist for Southeast Asia and India, Sanjay Mathur, sees India's big IT exporters adjusting to Donald Trump's $100,000 fee for new H1B visas.
It would be logical to anticipate that companies are able to perform many of these functions either near the United States, say in Canada, Mexico, or within India.
But first in 5 and 5 with ANZ, gold jumped through $3,800 an ounce overnight and is sitting at $3,859 US at 4 a.m. Sydney Melbourne time. That's up 1.3% from yesterday. That's on growing worries the US government may have to shut down as early as Wednesday if Donald Trump is unable to agree new funding with legislators. However, in this part of the world, the focus is on the Reserve Bank of Australia's cash rate decision this afternoon, which is expected to be a hold at 3.6%. Here's ANZ Senior Rate Strategist Jack Chambers to preview the decision.
We and pretty much no one, nor the market, are expecting a cut this week. What will be interesting is the change in the RBA's language. We got the August CPI indicator data last week, which surprised a bit to the upside. Market pricing has moved very aggressively. A few weeks ago, the market was fully priced for a November cut. It's now around 50% priced. And terminal RBA pricing, the total amount of easing priced in, has fallen quite a long way as well to just about 1.5 cut. We still expect a November cut from the RBA, but that is conditional on what the Q3 CPI data looks like and also how the labour market evolves between now and the November decision on Melbourne Cup Day.
As of 4 a.m. Sydney Melbourne time, the S&P 500 and the Nasdaq were up 0.1% and 0.4%. The 10-year US Treasury yield fell 4.4 basis points to 4.143%. West Texas oil futures fell 3.9% to $63.18 US a barrel. The US dollar index fell 0.2% with those lower interest rates. That saw the Aussie dollar rise 0.5% to 65.76 US cents. And the Kiwi also rose 0.2% to 57.81 US cents. Number 2. Jack says the focus after a hold then switches to the tone of the RBA's commentary.
What we expect this week from the RBA is not a change in policy, but a bit of a change in tone, which we've already had. We've started to already have. Governor Bullock, when she was speaking before the House of Representatives Economics Committee on Monday last week, she started hinting towards the data, if anything, is coming in a bit stronger than the RBA expected when it did its last set of forecast in August. We suspect they'll reinforce that message, especially with the inflation data we had last week.
Number 3. ANZ's head of FX research, Marja Ben-Zaman, says the Aussie dollar has done well in recent weeks. Thanks to market expectations, the RBA may not cut much, while the Fed may cut more, making the Australian dollar relatively more attractive for traders carrying the currency.
A couple of months ago, we had 3 RBA cuts priced into the swap market. Today, it looks like there's less than 2. So again, this is helping the Aussie at the margin. We still maintain our view for a final cut of 25 basis points at the November meeting. But I think, again, even with that, 335, when we look at carry and yield advantage, I think Australia or Aussie dollar will likely continue to have that carry advantage.
Number 4. The Aussie dollar's also strengthened a lot against the Kiwi dollar to a 12-year high last week. Again, thanks to diverging expectations on interest rates between the RBA and the Reserve Bank of New Zealand.
RBA and RBNZ policy has pretty much moved in tandem for most part, but there were some instances where there was a bit of divergence. Now, over the last week or so, New Zealand data suggests that we saw a softer GDP number. We saw RBNZ rate cut expectations fall to price in more aggressive easing. And this came at a time where Australia's data has been a little bit more on the positive side and easing expectations have retracted.
Number 5. Speaking of New Zealand, there was a 0.2% increase in jobs in August, with some industries showing some promise after a long, slow period. Here's ANZ Senior Economist Matt Gold.
Broad picture over the last year and a half or so since the peak in job numbers has been quite broad-based job losses across most regions, apart from some areas of the South Island and some agriculture-dominated areas, and a lot of job losses in construction, manufacturing, and some private sector services like retail trade. And it's hard to pull much out of the month-on-month changes, but we actually saw an increase in goods-producing sector jobs this month, which is the first time we've seen that in a while. So that's a promising sign for those industries.
Matt Galt there. Now, in our deep dive interview, ANZ Chief Economist for Southeast Asia and India, Sanjay Mathur, analyses the effects on India's economy of Donald Trump's new $100,000 fee for new H1B visas.
We think that the impact will be fairly mild simply because the overall quantum of people going to the US on this visa program, vis-a-vis the size of the labor force or the distribution of Indian workers overseas, is fairly small. And the second part of it is that this really applies to incremental visas as opposed to the existing stock of visas. Therefore, the impact should be fairly limited.
So just to give us a sense of how many workers from India are in the United States with this type of visa, how many go over every year, and sort of what share of the total labour pool it represents, because on the face of it, it has a high profile, but the number of incremental new workers going from India is not as large as you might think.
It is not. If we look at the numbers, every year there are 85,000 new H1B visas that are granted. Of this, about 70% go to Indians. Thereafter, if we look at this number, say 50,000, in relation to the annual addition to India's labor force, or in terms of how many people actually go out of the country, it's almost a negligible number.
And just looking at the earnings impact here or any sort of disruption to companies in India who are connected to this flow of people or the work that's done.
Yes, I think that is perhaps the most tangible impact. We do think that Indian IT companies who actually do project work, on-site project work in the US, they will have to shell out an additional $100,000. So if we assume that every year the total outflow on this account in terms of number of people is about 12,000 to 15,000. And if you were to add it to the cost of Indian IT companies, or at least the top 10 ones, what we'll see is that we could see a margin compression of about 1.9%. Having said that, it's also important to note that technology is getting more and more remote in terms of usage. Therefore, over a period of time, it would be logical to anticipate that companies are able to perform many of these functions either near the United States, say in Canada or Mexico, or within India.
And the services exports of India's financial and information communication technology sector has been a substantial factor in India's current accounts and its trade revenues. Could you tell us about any potential impact there and also what sort of effect there might be on remittances?
In the short term, I do not see any major impact. There are a couple of things to bear in mind. One, India's current account deficit is low to start. Second, the biggest growth is coming in global capability centers, which are banks, consulting firms, manufacturing firms, setting up centers for doing back office work. The value addition of the back office work is interestingly improving every year. So what really started off as a cost arbitrage now has become a value-added proposition for most of the international organizations that have established GCCs in India.
So when you say a value add rather than a cost arbitrage, could you expand a bit on that to say what that means?
Certainly. I think there was a time when if you were to take a typical financial institution, so the accounting processes were done there, some of the credit appraisals were being done there. But now we are moving to app development in terms of banking systems, in terms of payment systems. Likewise, in the manufacturing sector, what we find is increasingly there is a fair amount of design of products being done in India. So essentially what I'm saying is that basic functions that could be performed in India, that part is already completed. Now we are moving to a new level, which involves, for lack of a better word, functions where we thought that a lot of thinking and expertise was required. And now the same is being made available in India.
Sanjay Mathur there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, September the 30th. Catch you tomorrow with all the analysis and reaction to today's cash rate decision by the Reserve Bank of Australia. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.